Ladies and gentlemen, to the IEA's under embargo webinar for the presentation of our GAS 2020 report. Today to present our findings are Mr. Keisuke Sadamori, who is the Director for Energy Markets and Security at the IEA, and Jean-Baptiste Dubreuil, who is on the line with us today to also field some questions. As I said, this is our embargoed webinar, so the materials that you will be seeing are under embargo, just like the report that you've received for tomorrow morning. Mr. Sadamori will run us through a presentation of the main findings, and then we will be able to take some questions. Again, if you could just send us your questions through the Q&A functions here on Zoom. It's on the bottom right hand side of the Zoom. We'll try to take some questions now. If we can get to your question, please email us at press@iea, and we will be sure to get back to you today. Without further ado, I'm turning the video now to Mr. Sadamori. Keisuke, please.
Thank you, Jad. Good afternoon and welcome, ladies and gentlemen. So it is my pleasure to share with you today the main findings of our annual natural gas market report. In the context of the unprecedented crisis triggered by the coronavirus pandemic, this year's market report is providing a strong focus on recent gas market developments and the short to medium term impacts of the COVID-19 on global gas trends, drivers, and uncertainties. After 2 years of growth, the above 2% in 2016 and 17, and one golden year in 2018 at close to 5%, the gas consumption growth cooled down last year to slightly less than 2%, in line with the average annual growth rates observed before 2016. Field switching remained the main engine of growth, but with coal to gas gains being partly offset by the exceptional hydro and even some gas to oil switch. China and India, which are the main drivers behind the global gas demand growth in the recent years, they significantly slowed down on consumption growth. This year, 2020, is unprecedented at all levels, of course: health, macroeconomy, global trade, energy demand, and gas will not escape this global downturn. So this is uncharted territory. As of early June, gas demand is less impacted than other fossil fuels, like oil, than other fossil fuels. Unlike oil, little gas is used in transport, and low prices mean that the gas-fired power generation is making gains at the expense of coal in the United States, in particular, despite a decline in power demands. Despite these mitigating factors, gas is expected to face its sharpest drop ever, with an estimated 4% annual decline in 2020, or about 150 BCM of loss. And that's twice the loss observed in 2009, which was caused by the financial crisis. The last winter was one of the warmest recorded in the Northern Hemisphere, having a strong impact on space heating needs and therefore on natural gas demand for the residential and the power generation sectors. European gas demand in January was 9% below last year, recovering progressively until the implementation of lockdowns during March, which heavily impacted consumption for power generation and industry, dragging gas consumption 7% below last year's level as of end of May. US gas demand in the first quarter was 5% below last year, also impacted by mild temperatures. It partly recovered since April, in spite of lower demand from the industrial sector, thanks to low gas prices pushing further coal to gas switching in power generation. Major Asian gas markets have followed different trends so far. Japan, the world's largest LNG importer, saw its imports progressively decline compared to last year, impacted by warmer than usual weather, economic activities slow down, and the decreasing share of natural gas in the country's power generation mix. China recovered from the impact of lockdowns, but its growth rate remains sluggish at less than 3% year-on-year as of end of May. Several emerging Asian markets, like India, experienced a sharp increase in the first months of 2020, supported by ample and cheaper LNG supply. But the implementation of a nationwide lockdown in late March had immediate impact on gas demand, and which collapsed in April. The overall decline trend is also visible on the supply side, yet a comparison of the main supply indicators show different stories. On the upstream side, gas production in the United States and Russia, the world's two largest natural gas producers, follow two different paths. US gas production has so far remained stable, around 80 BCM per month since the beginning of the year, with gains from net pipeline trade and LNG exports helping to compensate the decline from domestic demand. This, however, contrasts with the growing trend seen last year. On the other hand, Russia's exposure to export markets, and especially to Europe, further accelerated its production decline in the context of lower demand and a strong competition with the LNG, resulting in a 9% drop of production year-on-year for the first 5 months of 2020. On the midstream side of supply, the global LNG trade volumes remained high in the first 5 months of 2020, close to 9% above last year's. Europe continued to play the role of balancing market in the context of a loosening supply, accounting for 2/3 of incremental LNG imports. However, the LNG volumes declined in April with the impact of lockdowns in Europe and emerging Asia. China and India's import kept growing in May, supporting the modest month-on-month increase in the global LNG trade as European flows remained stable. Europe's total imports followed a linear decline trend since the beginning of the year, with pipeline flows from Russia and North Africa both down by almost 25% due to demand decline and a strong competition with LNG. The combination of continued strong supply growth, mild winter weather, and the imposition of the COVID-19 related lockdowns pushed natural gas prices to lows not seen in over a decade across all major consuming regions. In the United States, Henry Hub prices in the first quarter of this year, 2020, fell over 33% year-on-year to an average of $1.9 per million BTU, its lowest quarterly price level since 1999. Prices continued to face downward pressure from a growing supply and subdued demand, falling to an average of $1.75 per million BTU in May. In Europe, the gas prices on TTF more than halved compared to last year, averaging at $2.6 per million BTU during the first 5 months of 2020, impacted by plummeting demand and a strong LNG influx. Since the imposition of the first lockdowns at the beginning of March, prices on TTF fell further to $1.5 per million BTU in May, their lowest monthly average since the Dutch hub was established in 2003. With day-ahead prices seen trading below the $1 mark during mid-May. The Asian LNG spot prices assessment halved year-on-year during the first 5 months of the year to an average of $3 per million BTU. Following the imposition of the lockdowns in India, Pakistan, and Bangladesh in March, spot prices have fallen to new historical lows, with months ahead contracts trading at an average of $2 per million BTU. So these very low price spreads between global gas benchmarks is practically closing the opportunity for any interregional arbitrage and potentially resulting in negative netbacks for certain suppliers. We anticipate in this forecast that the gas demand will be down this year for all regions and all types of uses. Geographically, the bulk of consumption decline is to be seen in mature markets in Europe, North America, and Eurasia, which would together account for 75% of total demand loss in 2020. These markets have been impacted by lower winter consumption in the first months of the year, followed by the implementation of lockdowns, which have hurt gas consumption in industry and power generation. The other regions, they are less impacted in terms of the absolute volumes because of the lower share of gas in their energy mix, and also because of their lower exposure to space heating uses. In Asia, some countries such as China or India would still experience some growth, although very limited. Sector-wise, power generation accounts for half of the loss, as gas gets squeezed in between the lower electricity demand from lockdowns and the sluggish recovery and growing renewable output in Europe or in Eurasia and the Middle East, where it is the dominant source of generation and is hurt by lower economic activity. Residential demand is mainly impacted by lower space heating consumption in the Northern Hemisphere, while the commercial and the industrial consumption is hit by the impact of closures during the lockdowns and the slow return to activity. Demand from the energy sector is affected by lower gas production, processing, and the oil refinery run. 2020 will be a record decline in the history of natural gas market, about 150 BCM, and that's twice as big as 2009 with the financial crisis. This decline in 2020 is likely to be recovered in 2021, but it will not be like the rebound in 2010, when the gas demand jumped by over 8% after a 2% decline in 2009 due to the financial crisis. Mature markets in Europe, Eurasia, and North America, which were the hardest hit in 2020, are expected to recover most of the consumption losses in 2021 as demand from the industrial and power generation sectors gradually returns. Some marginal gains are also expected from coal to gas switch, helped by low prices and ample supply, while residential heating demand is assumed to return to normal after an exceptionally mild winter in 2019 to 20. Additional growth comes from faster growing markets, mainly in Asia, fostered by the economic rebound and the competitive gas prices. The return to global gas demand growth also drives consumption from the energy sector in gas producing and the exporting regions, such as Eurasia, Middle East, and North America. After 2021, the Asia, led by China and India, drives half of incremental demand, followed by other emerging markets and especially the Middle East. However, this is not return to business as usual, as the current crisis is expected to have long-lasting impacts on natural gas markets. On the demand side, in spite of the gradual recovery, some of the pre-COVID-19 growth potential is lost. It is assumed that about 75 BCM per year of incremental gas demand will be lost by 2025 compared to our initial forecast. And that's the equivalent of last year's global gas growth. On the supply side, the current COVID-19 crisis will also have repercussions. Sluggish recovery and the slower demand growth coincide with the strong development of new LNG export capacity, resulting from a massive wave of new investment, which reached a record of $65 billion and over 90 BCM of 90 BCM per year of new export projects sanctioned last year. These capacity additions are likely to outpace LNG needs and increase the prospect of structurally loose LNG markets for the coming years, unless additional demand is triggered by even lower gas prices. But this loose market and the potential downside on prices will cast a long shadow on the investment in the whole gas value chain, both for the exploration and for infrastructures, which can in turn put at risk future market balance if production from the depleting fields is not supported by new developments. So finally, this year, the natural gas markets are hit by a conjunction of three demand shocks. One of the warmest winters ever recorded in the Northern Hemisphere, followed by unprecedented slowdown in activity triggered by the lockdowns enacted across the world to slow the progression of the COVID-19 pandemic, and an expected sluggish economic activity after the lifting of the lockdown measures. All the gas-consuming regions are affected by this demand shock. The more mature markets in Europe, Eurasia, and North America are the hardest hit, accounting for 75% of total gas demand loss in 2020. The global gas demand is expected to gradually recover in the next 2 years, but this does not mean a return to business as usual, as the current crisis will have a long-lasting impact on future market developments with slower growth rates. It also creates growing uncertainty on the supply side, as investment decisions taken over the past years to develop new production and infrastructure capacity would materialize in the lower growth environment, reinforcing the prospect of overcapacity and the low prices. Such a prospect casts a shadow on future investment, which will be needed in the long term to ensure the renewal of production sources and the global security of supply. Since the beginning of the crisis, the IEA has engaged with all stakeholders, governments, and industries to assess the impacts of the crisis on energy markets and security, and to develop roadmaps for sustainable recovery. As part of these efforts, our natural gas market analysis and the short-term forecasts will from now on be updated on a quarterly basis to better track recent developments and further increase transparency and understanding of the energy markets in this unprecedented situation. So thank you very much for your attention. Thank you.
Many thanks, Keisuke. We're going to now take questions that are being coming through the app. We'll take a minute while we collate the questions, and I propose to read those out, maybe a couple of at a time, to give Keisuke and Jean-Baptiste and other colleagues an opportunity to answer. So if you would just share your questions with us, and we'll take them in just about a minute. Thank you. Okay, so we're back, Sarah. Now that we've collected all the questions, I'm going to start reading them maybe by two or threes, and then perhaps Keisuke, you can start taking the first ones. The first one from Alex Forbes. Question is, given the clamor for governments to take climate action into account when designing COVID recovery packages, is a post-pandemic accelerated energy transition a threat or an opportunity for natural gas? Second one is, has the IEA developed a second wave of COVID-19 scenario? Perhaps this is something JB or yourself, Keisuke, can take. And then the third one I will take is, what is the consequence of this year's cuts in upstream? This is a question from William Powell. Will new production capacity be adequate to service demand towards the end of the scenario for forecast period 2025? Keisuke, can I just give you the first question?
Yes, in the recovery phase of the economy after the lockdown measures, we understand that all the governments around the world will take the kind of the stimulus, the measures, stimulus packages for the economic growth, and energy should be a very important element. And we at the IEA is emphasizing that those the recovery stimulus measures should be in line with the kind of a sustainable energy future, focusing on the clean energy transitions. And of course, it depends on what kind of measures the government would actually take. But and of course, natural gas is a fossil fuel, but at the same time, it's the kind of a least carbon intensive fuel, and also it has a very important role to provide flexibility to the electricity market with growing variable renewables like wind and solar. So in that respect, we consider that the natural gas will have a very important role to play in the clean energy transitions. And also natural gas, the gas itself, that gas itself should move to the kind of a cleaner energy future. And that's the reason why we have recently produced a report on the biogas and the biomethane by the IEA, which would be a very important factor in terms of the kind of utilizing the existing natural gas infrastructure for the cleaner, the energy future. So that's that's the answer to the first question. Secondly, the second wave of the COVID-19. Our basic assumption is that the global economy will grow back to the pre-COVID-19 situation without the big wave of the second pandemic coming back. So that's our basic assumption. But of course, it depends. So if the big second wave arrives in winter this year, for instance, then of course the outlook would be substantially kind of different.
Thank you. Can I just turn to Jean-Baptiste, who's on the line?
Yes, thank you, Jad. Good afternoon, everyone. Just to add on what Keisuke just mentioned about the macroeconomic framework, just to mention that even though we didn't explicitly touch on the potential second wave of the COVID pandemic, in our macroeconomic assumption framework, which was already shared in the recent Global Energy Review 2020 report, which was published a month ago, we do assume a strong and lasting impact of the current crisis on the global economy, with the GDP downturn of 6% for 2020. So, which covers a wide range of potential repercussions after the deconfinement of the global economy. As for the impacts of the production cuts on the medium term, of course, what we see today is massive budget cuts and even physical reduction in terms of gas output, being mainly prompted by lower demand and also by the side impacts of the downturn in oil consumption. And certainly the long-lasting impacts is one of the main uncertainty to this forecast. This being said, what we do see in the 5-year outlook is that most of the growth on the supply side will be concentrated in 3 main areas: the US, the Middle East, and Russia. So for the US, there is currently a cut in production, oil and gas production. The potential for a rebound will be intimately linked to the oil production rebound, especially for associated gas in the Permian Basin, for shale gas. There are in the short term some additional drivers which can support a rebound in US production, including the inventory of uncompleted shale wells. There's also some additional drivers aside from domestic production, including additional imports from Canada, which have been very low recently, and also using the cushion from the underground storage inventory. For the Middle East, we see that this growth is concentrated in a handful of very large conventional gas fields, which will, of course, be at risk in the current low oil price environment, especially for associated gas production. But it is fairly concentrated in a handful of countries. And for Russia, most of the investment which are currently underway are to be commissioned in the second half of the forecast, so beyond 2022, which doesn't mean, of course, that the current economic situation may not have impact on their schedule, but it is not for immediate commissioning.
Okay, thank you very much, JB. Perhaps the next 2 questions could go to you as well. The first question is, given the bearish gas demand, and this is from Sebastian Kennedy, given the bearish gas demand outlook, where does the IEA see value for investment along the gas value chain? There is a question from Vincent Colline asking to clarify about whether there is gas to oil switching. And then the third question from William Powell is essentially about what will drive, what policies will drive gas investments. Is it prices or specific policies?
Thanks. So on the first one about investment, the IEA has released very recently its World Investment Report, which shows the dramatic fall in investment that we see for this year. And of course, this will have this will cast a shadow on future supply capacity and the rebalancing of the market. One of the main questions is how fast the global gas trade, and especially the LNG trade, is able to rebalance in the next years. We see that after the very strong wave of investment over the past 2 years in new liquefaction capacity, the LNG consumption will be trailing behind the development of future liquefaction capacity, which leaves the market with, especially the large resellers of LNG, with open net position, which they will probably be actively looking to net on emerging markets, which drives new opportunity to create more liquidity and also to increase competitiveness of natural gas in those emerging markets, which are very price sensitive. On the regarding the point on coal and gas competition, which is linked to the previous one, I think it's a mix of both pricing and policies. We see that in both China and India, which are the two main drivers, which have been the two main drivers in the recent past, and which are likely to remain the two main drivers for demand growth. Policy is at the very heart of the stimulus, and both the Indian and Chinese government have very strong backing of natural gas, both as a development for their energy mix, and also as a replacement, especially in the case of China, to reduce the impact on air pollution in major urban areas.
Okay.
And, sorry, I missed one question. Excuse me. Which was sorry, Jack. Could you?
Yeah, the question was clarification on from Vincent Colline on gas to oil switching. Is this something that you've mentioned in the reports?
Sure. Well, this is not very major in terms of numbers, but it's an outlier. So we wanted to outline that. We have seen that in Iran at the end of last year, there was a shortage of natural gas availability for the power sector, which prompted some switching back to oil fuels for power generation at the beginning of winter. But that was a one-off case. This is not a general trend that we have seen for last year.
Okay.
It is not a general trend, but I need to point out that there was a change in the IMO regulations on the heavy fuel oil for the international shipping, and therefore the heavy fuel oil will not be demanded by the oil markets around the world. And therefore, in particular for the oil producing Middle East countries, there would be cases that very cheap heavy fuel oil with high sulfur would become a very cheap option of generating electricity this year and next. Thanks.
Many thanks, Keisuke. So we still have a few questions. I might just group them because they're fairly related. It's regional demand questions. One on the European policies moving away from fossil fuels. What does that mean for a new normal for gas? One on the impact of the pandemic on Africa, African countries, both production and consumption, so two regional questions. And a third set of questions on the impact in the US and particularly on LNG development in the US. Perhaps just in the interest of time, we can group those. Keisuke, if I can turn those to you first.
So as for the European countries, of course, the European governments are kind of accelerating the clean energy transitions, and we are seeing more and more cheap the variable renewables are coming into the market. And but at the same time, we are also seeing the fast decommissioning of the coal-fired power generations, and also the another source of a dispatchable low-carbon electricity generation, which is the nuclear, is also going down substantially in the European market. So the whole question is whether the renewable growth will be fast enough to complement those declines in power generation capacity, and so at least at least in the short term, the natural gas will have the role to play in terms of replacing those kind of declining power generation capacities. And also the With the higher share of renewables, there is a requirement for the kind of a flexibility balancing requirements, and the natural gas will also have a very important role to play there.
Many thanks, JB.
Yeah.
Just to add on Europe, that beyond power generation, the residential and commercial is also a strong contributor to gas demand in Europe. And this, the trends of change for this sector are much more long-term oriented. Of course, increasing energy efficiency will help reducing the consumption of gas for heating space uses and more generally for all distributed uses. But this and the electrification of heating, but we still see in the medium term that the role of gas in residential and commercial in Europe remains the cornerstone of consumption.
Okay, thank you. Maybe the question on the the impact on Africa, if you've done any regional analysis there on how will the gas producing African countries' budget be affected, or even just gas production consumption across the continent?
Yes, sure. Well, in terms of demand, most of the consumption in Africa is concentrated in the North African countries, mainly in Algeria and Egypt. And we've seen for Egypt, which is the largest consuming gas country in Africa, already a slowing down of consumption at the end of last year after 3 years of very strong growth with the commissioning of the Zohr field and some strong development in power generation. So we do assume, of course, that as for other gas consuming regions, the consumption is expected to slow down in these countries. In terms of production, there are two different impacts. The most visible impact is on pipeline gas exports. It especially targets Algeria, which saw its exports to Europe being strongly reduced since the beginning of the year, about 25% year on year compared to last year. As for LNG exports from Africa, we do see for the time being that LNG trade is still growing over the first 5 months of the year compared to last year. Even if it's slowing down, it's still above last year. So there are some cancellations, but we do expect that LNG trade will remain dynamic in the coming months, and that it will be the main engine for the rebound beyond 2020 and 2021.
Okay, thank you very much, JB. Maybe a last set of questions on LNG, which I have not addressed in the Q&A session from Sebastian Kennedy. I'm going to read a fairly long question, but with few LNG cargoes from Atlantic LNG exporters now arriving into US terminals instead of Europe, what should US LNG export projects, or should future US LNG projects recalibrate around bi-directional import-export facilities? JB, this one's for you for sure.
Thanks. Well, this is a very specific question. For sure, the US is expanding into very strong LNG exporter. It still has some import capacity in the Northeast with the Everett terminal and a couple of legacy import terminals in the Gulf Coast and on in the Mid-Atlantic, which have switched to bi-directional capacity. So what we see in terms of, so the two situations are a bit different. The Northeast still needs, for the time being, LNG to support through the seasonal needs for the winter in the absence of storage and sufficient pipeline capacity. For the others, this is more of an anecdotal situation, which probably relates to the current well supply market, because we haven't seen that much cargoes going into those terminals since the US expanded its liquefaction capacity since 2016. So I'm not sure this will become the norm in the future, that future liquefaction capacity should also consider regasification facility, given the cost competitiveness of domestic US production.
Okay, great. Thank you very much, JB. And that wraps the Q&A session. Just on a scheduling note, for the next few days and few weeks, we are holding tomorrow a live stream of a discussion, Q&A discussion between our executive director and the U.S. Energy Secretary. It's at 4 p.m. tomorrow afternoon. And you can find that on our various social media channels and our website. That's tomorrow. And then next week, Wednesday, we are releasing the World Energy Outlook, a special report on sustainable recovery. So that's one of the major analytical contributions we're making towards the COVID crisis, in addition, obviously, to our gas report, which we are publishing tomorrow. So the embargo for that lifts tomorrow morning. And then another scheduling note on July 9, the IEA will be holding its Clean Energy Transition Summit with a high-level attendance from a very large number of countries. We will be communicating about this in the next few days and coming weeks. And this too will be, portions of that will be open to the media. So thank you very much for your attendance. And if you have any more questions, please send them to press@iea.org. Thank you, Keski. Thank you, JB, and the whole team.
Thank you.